Welcome to Study Session 9, Audit of Balance Sheets Items. Introduction. Verification of assets and liabilities is an important aspect of final audit. You will remember that items of profit and loss accounts finally enter into the balance sheet in the form of retained earnings, prepayments, accruals, stocks, and so on. This lesson gives overview of audit procedures relating to major items of assets and liabilities in the balance sheet. Objectives. After going through this lecture, you should be able to design an audit procedure for verifying items of assets and liabilities. Audit of liabilities. A balance sheet will contain liabilities grouped under various headings including creditors, due either before or after 1 year, bank loans and overdraft, debenture loans, share capital and reserves, corporation tax, and deferred taxation. The note to the account will contain contingent liabilities. The auditor's task is to gather sufficient and appropriate evidence to ensure that the liabilities existence. The company is due to pay or discharge these liabilities, rights, and obligations. All liabilities which should be included have been included. Completeness. All liabilities have been recorded at their full amounts. Valuation. Liabilities have been properly disclosed at the financial statement. Classification. Verification procedures on liabilities. For trade creditors, the auditor will consider controls designed to ensure that purchased goods and services are properly authorized, documented, and only made for the purposes of the business. Only valid transactions are entered into the accounting records, and also test individual balances with third-party evidence. This could consist of evidence gathered from a creditor circularization, but is more normally carried out by reconciling purchase-ledged balances with statements from suppliers. For accruals, key audit procedures include identifying how the client determines all accruals required to be made, discover and test the procedures, check the schedule of accruals for arithmetical accuracy, check the calculation of accruals, compare with previous periods to ensure consistency. For provisions, auditors should establish procedures to ensure there is liability of some amount, for example, legal documents, claim letters, minutes of meetings, existence, that a company may be liable and that the liability will not be met by someone else, for example, an insurer, rights and obligations, that management have made as reasonable an estimate in the circumstances that the assumptions they have used are valid and that the basis on which it has been calculated is on a similar basis to that of previous years, if appropriate. Valuation. That provisions are properly disclosed in the financial statements, including any explanatory notes. Classification. For bank overdrafts and short-term loans, auditor should check the bank reconciliation and obtain independent third-party evidence from the bank. He should review the loan documentation. For long-term liability, auditors may review the loan documentation, confirm the company is not in default, and obtain a confirmation from the lender of sums outstanding. For dividends, earnings per share, capital, and reserves, auditors should ensure that share capital is properly classified and described in the accounts in compliance with the relevant legal requirements. Movements in share capital are properly authorized and correctly shown and described in compliance with the relevant legal requirements. Reserves are properly classified and disclosed in the accounts and that the provisions regarding disclosure of particularly non-distributable reserves such as share premium account are complied with. Verification of tangible assets. There are four key aspects to consider before we look in detail at audit procedures to verify tangible assets. Is it permitted to include these assets at valuation rather than original cost? There are extensive disclosure requirements where assets are shown at valuation. Auditors should carefully consider the depreciation policy. The amount to be written off these assets, cost less residual value, should be allocated on a systematic basis over the asset's useful economic life. Auditors should look for consistency in applying depreciation policies and be alert where policies are changed. Auditors should look at the question of impairment. Where the value of assets become impaired, in other words, they are not worth the value at which they are shown in the accounting records, they should be written down to realistic value. Assets which are leased are problematic as the auditor has to determine whether assets are financed through operating or finance leases. The reason why this is important is that costs incurred under operating leases should be expensed through profit and loss account, while assets acquired under finance leases can be capitalized. The control objectives in relation to tangible fixed assets are to ensure that all tangible fixed assets exist and are owned by the company and are in use, to ensure that tangible fixed assets are correctly recorded in the books, adequately secured and properly maintained, that acquisitions and disposals are properly authorized, that assets is properly depreciated and the depreciation is properly accounted for. Audit works on tangible assets, land and buildings. Physically inspect a sample of land and buildings existence. Inspect all documents of title, lease agreements, invoices, and so on related to the purchase or disposal of land and buildings. If title deeds or other documents are held by a third party, for example, a lender as a security for a loan, the lender should be asked to certify possession in writing, ownership, rights, and obligations. Inspect minutes of directors' meetings to ensure all agreements for the purchase or sale of assets are properly authorized and signatures on documents such as the title deeds, leases, conveyance, tenancy agreements, and so on are properly minuted and approved. Occurrence, rights, and obligations. Check a sample of entries in the asset register or asset accounts in the nominal ledger and trace back to source documentation. Valuation. Review depreciation policy and check sample calculations, all in relation to expected useful lives of assets. Valuation. Review assets for any permanent impairment of value. Valuation. Audit works on intangible assets. For research and development. Is a project technically feasible? That is, will it be completed and result in a commercial product or service? This may require the auditors consulting an expert to determine the answer. Is the ultimate product going to be used or sold? Consult minutes of meetings and discussion papers. Can the product be sold? That is, does the business have the capability to deliver the product to the marketplace? Again, meeting minutes and discussion papers will provide evidence of the company's thinking on this. Will the product or service provide an income stream? Is there a market for the product? What sort of volumes will be sold and at what price? If it's to be used internally in the organization, what sort of transfer price will be available? Market research reports will give guidance on this. Are resources available to complete the project? How much longer will it take and how much more will it cost? Budgets, plans, and forecasts will evidence this as well as evidence of cost charged to date. Development costs should be amortized, depreciated over their expected useful lives, which is either the length of time the resulting product or service is in production and being sold, or if this is an inordinately long period, the value should be reviewed annually for impairment. For trademarks and patents, these should be capitalized and written off over their expected useful lives. The auditors should consider the value each year. It may be that because of technical changes or changes in rules and regulations, the value of a patent or trademark becomes impaired, in which case it must be written down as the income stream from it will reduce or cease. The auditor should check that any renewal fees have been paid and written off, so the patents and trademarks are still current, and the auditors should also inspect the agreements to make sure that they are still current in the name of the company. If the company uses a patent agent, it may be possible to obtain a third-party confirmation from them as to the ownership and currency of the patent. On stock and work in progress. Value. The accounting standards require that stock and work in progress should be valued at the lower of cost and net realizable value. Cost includes cost of the actual item plus any cost related to bringing it to its present location and condition. So can include import duties, transport costs, handling costs, and so on, and net of any rebates or discounts. Net realizable value is the estimated selling price of those goods in the ordinary course of business. This can be calculated after deduction of a proportion to cover selling and distribution costs if this is appropriate. Auditors need to review selling prices of stock items after the year end, as the market price may be less than cost. Stock taking. Stock taking is essentially a part of the internal control system. A good set of stock taking procedures will have the following characteristics: good planning so that the work is carried out carefully and systematically, early issue of stock taking instructions with considerations of feedback from staff, division of the stock take into manageable areas for control purposes, nomination of people responsible for each aspect of the count. These should ideally be persons independent of those normally responsible for the control over stock items. This is based on the internal control principle of segregation of duties, separating those responsible for control of stock and those responsible for counting it. Written instructions to counters for counting, weighing, measuring, and checking should be issued, and all counters must ensure that they are familiar with them. Controls to ensure all stock is counted and once only. The auditors must satisfy themselves as to the validity of the amounts attributed to stock and amounts in progress in the financial statements. They do this by first considering the client's system of internal control. While detailed work on stock and work in progress is imperative in an audit, there are a number of analytical review procedures which the auditors should carry out in order to provide additional substantive evidence. These could include reconciliation of changes in stock at successive year ends with records of movement, for example, purchases and sales, comparison of quantities of each kind of stock held at year end with those held at previous year end, and the purchases and sales. Consideration of gross profit ratio with that of previous years, other companies, and budgeted expectations. Consideration of rate of stock turn with previous years, and so on. Comparison of stock figures with budgets for stock sales and purchases. Consideration of standard costing records and the application of variances in the evaluation of stock and work in progress. audit work on bank balances. The auditor will be gathering sufficient appropriate evidence to verify that the balances are in the name of the company existence. The balances belong to the business, rights and obligations. The balances due are correctly stated in the appropriate value, valuation and allocation. All balances due have been recorded. Completeness. Auditors conduct examination and investigation of the bank reconciliation, noting the treatment of uncleared checks that have been cleared after date. These are payments which have been issued by the organization and entered into the cash book, but which have not yet been debited to the account by the bank. They should be checked to ensure that they are cleared after the balance sheet date. Lodgements credited after date, but actually paid in before date. These are deposits into the accounts which have been entered into the cash book, but which had not been credited to the account by the bank at the year end. They should be checked to ensure that the receipts are cleared by the bank and are not subsequently reversed. The auditors should look for evidence that the bank reconciliation is prepared at least monthly and that it is reviewed periodically by a responsible official or checked by internal audit.